Thank you. Thank you all for spending your Saturday with us, your precious Saturday morning and afternoon. We have the pleasure of being the last panel for this conference, and we'll be touching on the topic of investing, in alternative investing. So what exactly is alternative investing, or alts, as we know, short form as alts, right? So it's not a traditional asset class, as most of you might know of like equities and bonds. It tends to be illiquid in nature and also not publicly traded, and higher minimums when it comes to investing. But there are many people, like for example, pension funds and also endowments and also high net worth individuals have always been investing in this space. And as you heard in the previous panel from Joy, she also mentioned that pension funds have allocated 20% and even up to 40% into alternatives. So in recent years, a lot of individual investors have garnered interest in this space. And that is largely because platforms such as Endowus have started offering access into alternatives. And also, secondly, there have also been, fund houses that have been providing semi-liquid, Hi, okay, I'm back. Yeah, so fund houses have also been providing semi-liquid structures to make, everything a bit more liquid, and also having, the funds registered for retail audiences so that more people can actually invest into it. So before we begin, maybe I'll hand it over to the panel to do a 30-second round of introductions before we begin. Over to you, maybe Melanie first.
Sure, thank you so much, Sheryl. All good on the mic?
Yeah. Good.
Very good afternoon, and thank you for having me here today. My name is Melanie. I'm from UBS Asset Management. I've been with the firm for about 8 years. In the early parts of my career, I cut my teeth as a financial advisor at the local banks. I've spent about 8 years working in local banks and another 15 years with asset management firms. So indeed, a pleasure to be here to speaking to all of you today.
Thank you, Melanie.
Hi, everyone. Hi, my name is Pin, and I'm a partner at Lightspeed Ventures. We invest in startups like household names that you hear today, like Grab, Snapchat, Oyo Rooms, but 10 years ago, right? So it's an asset class called venture, and it is a very high-risk one, so I'm happy to share more today. And as a full disclosure, we are also an investor in Endowus, so to the extent that I should disclose that, and also that I'm not a certified financial advisor, but I'm more than happy to share how, at least for me as a venture investor, I kind of manage my personal portfolio. So glad to be here.
Good afternoon, everyone. My name's Dominic, partner at TPG, based here in Singapore. I've been with the firm 18 years, which has been my entire professional investing career, and these days co-head our business in Southeast Asia. TPG is one of the world's largest alternative asset managers. We have about $150 billion under management, mostly in what we would call private equity, and as we talk more this afternoon, we'll unpack a little bit what that is, but good to be here.
Hi, good afternoon, everyone. My name is Jeremy, and I'm the General Manager at MDAC, covering corporate finance and strategy. MDAC is a B2B focused fintech, specially focused on cross-border transactions in foreign exchange and payments. So prior to moving into fintech, I spent 18 years as an investment banker, looking after Southeast Asia, doing IPOs and M&A. So I'm an avid investor, and I'm also an Endowus client.
Yes, I'm pretty sure everyone will find you familiar, Jeremy. You're an Endowus advocate as well. Yeah, so Melanie, if you could start us off, could you maybe give us, an introduction of, what exactly is this asset class alternatives? How does it differ from traditional asset classes that we're more familiar with? And also, how can clients or investors think about adding this into the portfolio? When do they start adding this into their portfolio?
Sure, and Sheryl, as you alluded to, Sheryl? Sheryl? Yeah, thank you. I think the mic is going on the early weekend break.
Yes, it is.
So yeah, Sheryl, as you alluded to earlier, in terms of alternative investments, when most of us think about investments, we tend to think about traditional financial instruments like your bonds, equities, but that is actually a whole array of alternative investments that are actually unconventional securities. You have, for example, your private equity, hedge funds, commodities, as well as private debt. So I'm going to break it down in terms of 4 by 4 to everyone. So there are actually broadly 4 common alternative investment strategies. The first one is private equity. Private equity, as the name suggests, is private. It's capital invested into unlisted, where you get actually a premium over equity or ownership. And at the same time, investors who invest in private equity they actually get higher returns at the same time. The second option is, the second alternative strategy is private debt. So similar to private equity, this is actually capital invested into debts of companies. So managers invest in private debt to restructure debt, to also restructure default debt, for example, as well. The third category is real estate. So real estate in terms of residential, commercial, industrial types of real estate, either in primary or secondary real assets. So as for managers like us at UBS Asset Management, we invest in real estate via a variety of areas. For example, we can buy into properties for refurbishing, we can buy into properties for development projects or repositioning projects, and this actually has been actually known as a good inflation hedge for investors' portfolios. The fourth category is hedge funds. Now, I'm not sure how many of you are born in 1949, or most of us were actually, if I look across the floor, many of you are not born then. Now, Alfred Winston Jones, he's the man, if you Google it, he's the guy who created the hedge fund strategy in 1949. And why he did that back then was because there was a lot of uncertainty amongst economies, how the markets would turn out. And his idea behind developing a strategy was to have a strategy that is not correlated to markets and to generate stable returns. So his approach was to do something very simple as buying into unvalued companies, right? And also short sell into overvalued companies. And with that, he's actually taking a profit from the difference between the two. Now, this approach is actually designed to have returns that's uncorrelated to the market direction, as long as you're buying the right stocks, as long as you're buying the right companies. And that's how the word hedge originated. And that's how hedge funds, since this was launched the first launch was in 1949, we have seen trillions of assets in assets under management for hedge funds. And today we have easily about 10,000 hedge funds being created. Now, so 4 by 4, I've talked about the 4 categories: private equity, private debt, real estate, as well as hedge funds. Now, I'm going to also briefly talk about the various types of hedge fund strategies. Now, in hedge fund strategies, as I mentioned in the example earlier in terms of buying into undervalued companies and short selling overvalued companies, that is actually an equity long-short hedge strategies. On the credit aspect, the second area, we could also do the same thing, except that you actually long and short into fixed income securities, credit. The third is actually on, we call it relative value. Now, relative value, RV as is known, in short, basically is where arbitrageurs, they look for mispriced assets. They buy into assets that are mispriced, hoping to take advantage of the price discrepancy and assuming that these securities actually return back to true value. Last but not least, the fourth is actually on trading. Trading is actually a very interesting strategy whereby fund managers like ourselves, we also invest into trading approaches using either quantitative and buying into very highly liquid instruments. So in a nutshell, there are also various types of hedge fund strategies depending on client's profile, experience, etc. And I think, Sheryl, your question also was about when should investors look into investing hedge funds, right? Mm-hmm. So, or alternatives for that matter. In terms of when, bear in mind that when it comes to alternative investment strategies, it comes with certain form of illiquidity, right? And if you have that tolerance for illiquidity, and also at the same time that risk appetite to be able to stomach higher risk as well, then the timing should be any time, looking at it from an SAA, TA perspective.
Thank you, Melanie. I mean, you gave a very good in-depth, view about hedge funds, but maybe now we can move on to, pin what you're doing best at, right? Lightspeed is, one of the, early investors in a lot of good startups and venture capital firms. Maybe if you could share with the audience here, what exactly is a venture capital firm? Is it something that individual investors can invest into? And on top of that, when you actually look at investing to a VC firm, for example, what do you actually look out for?
Hello, this good?
Yeah.
This one hasn't gone to lunch yet. Good mic. So maybe as a, just a quick 101, I would broadly, say that venture asset class is a subset of a private equity, right? It's just a much smaller scale, much higher risk. So I'd say I'll categorize that as underneath. So I guess people who have access to it today, at least still are, high net worth individuals, pension funds, or endowment funds, for mostly in the U.S. or firms like GIC, Temasek. So these are typical clients of venture firms, right? So just a quick 101 of what we do. And traditional venture firms invest really in technology-driven innovation companies, right? So if you just take household names that you hear today, Grab, Snapchat, Oyo Rooms, Pinduoduo, Alibaba, these were, 10, 15, 20 years ago, really companies that were just started by 2 to 3 people in a garage, right? I was an early member of Grab. 10 years ago, the company was valued at $15 million, right? Today it's trading on NASDAQ for maybe as of yesterday, maybe $15 billion, right? So this is the kind of journey, and essentially what we, in the top quartile, venture firms, we hope to return or give a return of about 40%, year on year compounded. And obviously, next question is then, wow, this is a great return. Why aren't everybody in venture asset class? Because there's risk, right? Many people, we only hear the heroic success stories, right? Gojek, Tokopedia, Grab, Facebook, Amazon. All these are the success stories of venture firms. But along the way, not many people know that to find even one Facebook, there were 90 others that didn't make it, make it into news. So the reason why not everyone should be investing in venture asset class is because there's risk. There's inherent risk, and the inherent risk is much higher than what you would probably get when you're investing in, maybe more later stage, private equity firms, private equity asset class, or even stocks or bond, right? So that's basically what we do, and why at least as our firm, believe it's, many people have different strategy. Like our strategy as a global venture firm is really to, go on a journey with these founders very early, and provide them with really not just money, but time and resources, and our network that we can bring with kind of the global brand to really change the trajectory, to change the trajectory of these investments or these founders, right? So so that's kind of a little bit of 101 of what we do.
Thank you, Pin. So when you're actually meeting all these VC firms, right, there's so many of them, what do you actually look out for? What stands out?
Sorry, just to clarify, as day to day, I meet founders, right?
Founders,
so they invest, So and maybe I'll just use Endowus as an example because, again, full transparency, we're an investor in the firm, right? A few things. One is, a very, very big market, right? So I do not invest in, even the most high-flying bubble tea store, right? Like bubble tea store for me, even if they return amazing money, it is not a category that is suitable for the venture asset class. Because for me, once again, if only 1 in 100 will make it to Facebook, then I think every time I invest, I need to really think if there is a possibility that this could give me could cover, I'd say, at least internally our speak, a very large surface area, right? So maybe some person starts with, I think with Endowus, they started with just helping you invest in CPF, but I need to really imagine that, one day, we'll be Sam and Greg and his team would be able to go beyond just helping people invest in CPF, but to also invest in, the money markets and to invest in, the private equity firms and to have conferences like this. So I guess my kind of vision turned out to be true. But that's a little bit about, what we look for, like a very big market, maybe a wedge, and then something that we can eventually, hopefully, right? If I invest a lot in consumer net companies, hopefully, 1 in 5 people on the road has the potential to use this, as part of their life's journey. So that's number one, a very big market, and then number 2 is really just a team. There's good team and then there's great team, right? I think a great team really takes the form of, at least again, just sharing a venture speak. You look for team and market fit. Not, every student or not every person with a HBS degree or come out of, a tech executive who spent 10 years in DBS, the best performing DBS executive. These are not necessary clear signs of good teams, right? Good teams depends on what they're working on and why they have an edge in doing what they do, right? So again, just taking an example of Endowus, I think the founding team was a great combination of someone who, like Sam, who had years and years of experience in really asset advisory and asset management, right? And he has the drive and the grit to really want to make a big difference. It's not incremental, right? It has to be huge change to the industry. And then he's teamed up with, Greg, who has spent, again, multiple years, right? Came from Hong Kong, and his family, is really has deep knowledge in, wealth management. He spent a lot of time in Grab and, really understand kind of how to move the really bits together to make this work, right? And I think that combination, at least for me, is a very powerful combination. It's a very good starting point. The risks are still there, the work is still hard, but I think it's a very good starting point to build what I actually believe is going to be kind of the next wealth platform of Asia.
Thank you, Pin. Now moving on to, private equity 101. Right, Dominic, you're a partner in TPG where you run many PE funds. But could you maybe break it down a little bit for us to let the audience here understand a little bit more about what exactly is private equity? It tends to be a little bit less opaque in terms of disclosure when it comes to investing into companies as compared to, I would say, investing into a public equity. Right? So how can clients or investors think about this? And also we hear, I know a lot of questions in one. We also hear this term GPLP very often. Could you just, explain to us what that is about?
Sure. I guess a few topics in there, so I'll try to take it bit by bit. As Pin said, VC is really a subset of private equity, which is a subset of the broader alternative asset space. And the private equity industry has been around now for probably 50 years or so. It just wasn't called private equity when it first began. When it first began, it was a group of people who would spot an investment opportunity, usually something that wasn't available in the public markets, and then they would gather a group of investors together to make that investment. And so to be able to make large investments, it meant gathering money from usually pension funds, possibly insurance companies, who had the ability to deploy large amounts of money. As the industry has grown and matured, it's come to be known as private equity. And these days, as well as gathering money from pension funds and insurance companies still, we're also gathering money from sovereign wealth funds, but also wealthier individuals, and increasingly, through various different means, also there are ways for people to access private equity at even smaller check sizes. What we do, which is different to what Pin does, is I would love to be able to generate 40% returns, but the returns are probably more like 20 to 25%. But the reason for that is we're taking less risk, and in taking less risk, we would really be investing only in the best of the companies that graduate from a VC firm. And if I could take an example that you might all be familiar with, which is Property Guru. It's now a listed company on the New York Stock Exchange, but when we first invested in that was about 8 years ago. Before we invested, various VC firms have invested in the company, so it had sort of proven its ability to make money. By the time we invested, we helped the business expand into multiple markets, and now it's a profitable cash-generating company that's available for people to invest in the public markets. And so it's a good example of how a business can graduate from VC to private equity to public markets. The other reason I raise that example is what we're trying to create for investors is things that they can't necessarily access in the public markets. People are not going to pay us fees to do something that they can go and do in the public markets by themselves. I think this is a little bit where the transparency point comes in as well. And I think we often hear it that private equity is not a very transparent investment category, and I think that comment is fair in some respects and unfair in others. And what I mean by that is if you invest in the public markets, you get a fair bit of information about how your company is performing every quarter or every half year. They will publish quite detailed financial statements. The question is, though, what are you going to do with that information? You can only make a decision to continue to hold your investment or possibly to sell your investment, but there's really no ability to influence what the company is going to do, at least as an individual investor. When you have a private equity manager and you invest with us, from where we sit, we get a tremendous amount of transparency into what our companies are doing. So we would usually sit on the board of the company. In some cases, we would control the company. And the level of detail that we get is much, much more than what you would get as an investor in a public company. And so we get a tremendous amount of transparency. And we think a lot before we make an investment in a company about how is the governance of that company, how is the quality of their own information, how transparent are they with us when we're considering making the investment. So we, in a way, you're sort of outsourcing that transparency to us. The reporting that we give back to our investors is on a portfolio basis because we're putting together a portfolio of companies and we're very transparent about our own returns. But admittedly, the amount of information you get about each individual company will be less than if you're investing in the public markets. I think the last of your questions was around sort of a GP and LP, which is a term that you hear quite a lot. And the acronyms mean general partner and limited partner. That probably doesn't help answer the question, though. And these acronyms go back to the very beginning of the industry when these clubs were coming together to do deals, and they were typically structured as partnerships. And the best way I could sort of simplify it, I think, is think of the general partner as the manager and think of the limited partner as the investors. And really what it means is the general partner has the discretion as to when to buy the investment, how to manage the investment, when to sell the investment, and the limited partners or the investors enjoy the returns from the investment.
Thank you, Dominic. Now I think the most important part is how do we apply what we have learned from the panel here, right? So Jeremy, we probably need your help there. So as an individual investor, what are some of the learning points that you have made throughout your investing journey, especially when it comes to alternative investing? What sort of risk do you think all of us should be thinking about, and how do we view risk reward when it comes to investing in such a space?
Okay, great. So the title of this talk is Alternative Investing 101. So I feel like I am the 101 here. I'm the basic guy, right? But I can share quite a bit about my personal experience investing in alternatives. So I've done personal investing on the side, on a seed stage, angel investing. And I've done this in tech startups, in apps, like what Pin does. But clearly, at that time, it was so exciting. I got involved, and I got friends to did a fundraise, and I went to invest, and I was very involved in go-to-market strategy, what you should do. So it's an app for like food. It's something like Hungry Go Where at that time, many years back. But guess what? After a while, it basically died. So I lost all my money, and so did my syndicated friends that I brought into the investment. So that was my first experience in, I say, early stage investment. Later on in life, I was approached to do a Series B investment into a solar company. So I was like, yeah, okay, this sounds pretty interesting. Solar, renewable, many years ago as well. So it's a Singapore company. So I put in money, I invested. This time round, I was smart. I didn't get anyone to join me, right? I didn't want to bear the risk. So I did an investment, and this one turned out well. I actually made money. So I made about 2.8 times money and money over 5 years. The exit was that this company was via a trade sale to a Spanish company, recently reported in a newspaper. So that was pretty nice. So I had my first taste of a PE type investment, right? I would say growth equity. And from my experience, I enjoyed the investing experience, but I felt like the key takeaways is that there's a lot of concentration risk if I'm just doing it on my own. So I put in one asset or one bond, you're really exposed to that particular underlying asset and its performance. And if you don't have time to track it, I think your time is better spent, focusing on your real job, right? So for me, that was one. And I guess in investing in this asset class as well, a lot of the times it's about access. So I was very interested in hedge funds and also PE, but a lot of the funds are not open to, I guess, retail or AI, and the fund requirement is quite high. It's a very high capital outlay. So even for the Series B investment that I did, it was fairly lumpy capital outlay. And that, again, increases your concentration risk based on your own personal portfolio. So I feel like these challenges with the world today and the technology that's available can be mitigated by having a platform where I can go in, and the minimum investment size is lower, so I get to see what all the choices are, and I can spread out, right? Like what was mentioned earlier about the 4 buckets. I can put a bit in PE, I can put some in private credit, and maybe some in VC, and I can tailor that. Back then, many years ago, when I started this investing journey, we didn't have that option, and so I just dabbled my hand in it. And I guess also in alternative asset class, I did dabble also in crypto. So I managed to do some DeFi, yield farming, staking coins. I also got burned, right? So right now, I mean, personally, I limit my exposure to this asset class to about 5 to 8% of overall portfolio, but it is an exciting asset class. Right now, I am doing a bit more research personally on the private credit space. I was just asking ChatGPT yesterday some questions. So still learning, still enjoying the journey, and clearly I think that the panel here have hopefully shared much more than my basic 101.
Thank you, Jeremy. I think you had some foresight because one of the second top voted questions was actually about cryptocurrencies. And I think you adequately answered the question. So I'll go to the top most voted question, and undoubtedly it's about fees, right? So in the alternative space, especially hedge funds and also private equity, the fees tend to be higher than as compared to buying an ETF or buying an index tracking fund. So comments from the panel in terms of are these fees warranted? Dominic, looks like you're the best person for this question.
It depends on the returns. So look, I would look at it as what returns do you get as an investor, and if you're in a top quartile private equity fund, it should be more than a 20% return even after fees. It will be higher than that, obviously, for a VC fund. In our industry, there are 2 parts to the fees. There is a percentage of assets under management, and usually the bigger the fund, the smaller that percentage will be. But then probably the more important part is what we call our carried interest, which is a percentage of the profits. And that's actually the bigger piece of the fees, and it means that we're very well aligned with investors because we only get those fees if the investments are profitable, usually over some sort of hurdle return, which I think is different to perhaps a more passive investing style where the incentive for the manager is to grow AUM as opposed to how profitable that AUM happens to be.
Thank you, Dominic. I think the next question, maybe Melanie, if you could help us out on, is about asking what are additional benefits such as hedge funds? How does it provide long-term, help to achieve long-term goals for retirement, let's say? Does not need to be particularly hedge funds, can be also private equity or any of the alternative space.
Sure. Maybe I can touch a bit about some of the trends that we're seeing from a UBS EM perspective. And we've really seen an acceleration in terms of clients allocating to alternatives. And we've recently also commissioned a survey to understand what are our clients and what are investors thinking of. And I think the common driver behind the decision to invest more into alternatives has been diversification. That's really the free lunch here, isn't it? In terms of the ability, if you diversify across not just traditional bonds, and equities. Now, so within the alternatives strategies, the type of alternative strategies, what we've really seen also is or more into alternative mutual funds. So the more liquid type of strategies as well, that's actually has been also taking up a lot of interest. And to that point also, I was very intrigued by the survey results that fellow speaker Gayton from Amundi showed earlier, where he actually showed the chart in terms of investors' appetite for alternatives. And I was particularly honing in on that bar chart that actually showed that high net worth investors versus retail investors, and the allocation of alternatives of retail investors actually is at 0, if I'm not wrong, whereas compared to high net worth individuals, it is actually at a significant, I think it's a 35 or 36% allocation to alternatives. So that actually, again, it goes back to what we commonly see, right? Many jurisdictions actually limit the availability of alternative investings to retail investors. It's typically more catered towards the institutional investors or even the accredited high net worth individual investors. And that's because of also the higher risk element to alternative investments. However, in Singapore, we've seen that actually within the asset management landscape, alternative fund sales actually has grown significantly in the past years vis-a-vis traditional. All right, and my point here is that despite the overall more education about alternatives, I think retail investors have actually only started because traditionally all this while alternative investment has been actually more suited, more catered towards the high net worth and institutional investors, right? But back to what we're seeing also as well in terms of the trend that's dominating diversification, and as AIA CIO earlier, Chun Yan, she mentioned, right, with the fragility and the macro uncertainty likely going to drive markets, we will likely see more and more interest in this space as well, because alternatives do provide a better return stream as well, uncorrelated, of course, being risk aware about that aspect as well. So I think this is a trend that will continue to stay.
Thank you. I think we'll probably take another one or two last questions from the audience. And I think Pin, you can probably help us out on this because it's very specific to startups. What are the financial metrics to use when evaluating investing in startups, especially when they are still not profitable and still cash flow negative?
Good question. So I think it really varies, from business to businesses, right? So, everybody fundamentally wants a profitable company, free cash flow that's hopefully very, very scalable, at least in venture asset class. And so the journey to that obviously has different drivers, right? If you are a wealth tech company, then it could be driven by the number of customers that you are, adding on year, day to day, month to month, right? You're also looking at, AUM per user, right? So how much are individuals putting onto your platform, and is that growing over time? If you're an e-commerce company, obviously, then there's whole different metrics, right? Like how many merchants have you onboarded? How active are your customers? How many of them are, profitable customers? How many of them are, loss-making customers? And you can use these underlying metrics to project towards sort of hopefully 2-3 years or 10-year time frame as you think about it, to kind of keep the company focused, at least, all right, on a path that will hopefully create a lot of free cash flow in a highly scalable way, right? Again, this is not about a business that will take 20-30 years to get to $20 billion outcome, right? Our fund cycle or our investment horizon is hopefully in 10 years, right? In 10 years, I find, I invest something, and hopefully 10 years, it becomes a grab, right? So that's a little bit of how, we think about it, and what are the drivers that we are looking for in the early days, and then or what we hope for, right, in the later days. And I would also say that a lot of the metrics in the early stage startups are qualitative. Again, I say this because a lot of time is really about the founder. So we take a lot of time to do founder references. This is like 2 hours of me spending time with them and really debating on, the market, the product decisions, the trade-off that it's going to make. And these are like, I would say, qualitative measures. So I would just go back to, Jeremy, you made a really good point about why I think the difference between Jeremy and myself and Dom is not that individually we are any smarter, right? But actually the difference between, three of us is actually between Dom and myself have a large team really behind working for us to give us, information, right, sourcing, and to give us time to evaluate and be with the founder and and understand the problems and how kind of help them problem solve, and eventually also to help them exit, right? So this is really the only reason why I actually, for example, don't invest in any other funds in my own asset class, because I believe my firm Lightspeed is top quartile firm. But when I invest, I obviously have an asset allocation that is in growth equity, in bonds, in stock markets, and actually a lot of time, and that's why I think Endowus has been such a crucial part of my financial journey, is because I believe in any other asset class there is a Dom that does better than this. There's a there's a Dominic that does it better than me, and I'm sure if I have to invest, I'm not familiar with what you do, Jeremy. If you are the top quartile at what you do, I will also allocate my money accordingly. So that's really the philosophy, or at least my personal view on why we should access certain funds, or get advice from certain people, right? It's like, if everybody can teach Chinese tuition, but you're not Barry, like go to Barry's, right? If you want good Chinese outcome. So that's a little bit about at least my personal, investment philosophy or asset allocation philosophy.
Yeah. We've actually come up to time, but I will take the last question. Just bear with me. It's asking about what alternative investment options does Endowus have? I just have to answer this question, right? So we do offer hedge funds and private markets, funds on our platform, and they tend to be semi-liquid in nature. We do have offerings for accredited investors and also for our retail clients. So please do approach the client advisor team. They're all around the floor and outside. And also please approach our investment office folks. They are also here as well. And so on that note, I just want to thank you all, the panels, for all your insightful, comments and views. And thank you.